Have you ever looked at, say, a company's stock price or maybe the numbers for a bond and just wondered, how do they decide that figure? It can't just be random, right? Well, today, we're doing a deep dive. We're getting into the weeds of how financial assets actually get valued.
The real secret sauce.
Exactly. And our mission here is simple. Pull out the absolute key stuff from your sources on security valuation. Think of it as like your shortcut to understanding how these assets get their price tag. We want those aha moments for you without you feeling buried in jargon. It's giving value.
Totally. So we're going to unpack the main ideas. What even is an investment? How do you value shares? What about those super quick money market things? And we'll even talk about the people who do the value in the valuers. What's their whole deal? Ready to jump in?
Let's do it. And what's really cool is that getting valuation is, well, it's fundamental. It doesn't matter if you're building your own portfolio or, part of some huge corporate takeover deal. The basic ideas, they're always the same. Kind of like searching for the perfect friends episode, the quest is constant. Huh. Okay, so let's start right at the beginning then. The idea of an investment. What does that actually mean according to these sources?
Right. So an investment, at its core, it's putting your funds somewhere with the expectation of getting a return. Pretty simple idea. But that return, it needs to cover a few things. It has to compensate you for the time your money's locked up, for inflation, prices going up, and importantly, for the risk you're taking. No cap.
Okay, time, inflation, risk. Makes sense. Not just about getting more back, but enough more. Which brings us to something really key. Intrinsic value versus market value. What's the difference there? Why should we care?
Crucial distinction. So every investment, it throws off future cash flows, right?
Yeah.
And it also has a price tag in the market right now. The big goal in valuation is figuring out its intrinsic value. Like, what's it really worth based on its actual financial health and prospects? You then take that intrinsic value and stack it up against the market price. Is it cheaper than it should be? More expensive? Or about right? That comparison, that's everything for making smart moves.
Right, knowing the true worth versus the sticker price. Okay, let's talk returns then. First up, the required rate of return.
Okay, the required rate of return. Think of it as your minimum expectation, your non-negotiable. It's the lowest return you'd accept for making that specific investment, considering its risk. It's also called the opportunity cost. Basically, what's the best return you're missing out on from another investment with similar risk? Could I be any more selective?
Okay, so it's the hurdle rate. Got it. What about the discount rate then? How's that different?
Good question. The discount rate is the specific number, the percentage you use to pull future cash flows back to their value today. It's how you calculate present value. It's built from a risk-free rate, like what government bonds pay, plus a risk premium added on top for the specific investment's dangers. Now, technically, you could use different discount rates for cash flows arriving at different times, because risk might change. But often, for simplicity, people use one single equivalent rate that gets you pretty much the same answer.
Yeah, the sources had that example, cash flows of like €100, 200, up to 500 over 5 years. Using different rates each year gives a present value of 4,278.89. But interestingly, you could just use one single rate, about 4.4861%, and land on almost the exact same present value. It's about finding that balance.
Precisely, finding that equivalent single rate. And then there's the internal rate of return, the IRR.
IRR. Okay, what's that one telling us?
The IRR is the discount rate that makes the present value of all those future cash flows exactly equal to the investment's current price. Think of it as the average annual rate of return the investment is sort of promising, based on its price and expected cash flows.
Okay, an example might help here. The sources say, invest $20,000 now, get $3,000 in year 1, and $23,000 in year 2. The IRR works out to 15%. And this seems important if you only manage to reinvest that first $3,000 payment at, say, 10%, not 15%, your actual return drops a bit to 14.67%.
Exactly. That's a really critical nuance. The standard IRR calculation kind of assumes you can reinvest all the cash you get back at the IRR itself. If your real-world reinvestment options aren't that good, well, your effective return is going to be lower than that headline IRR number. It's like when Joey tries cooking something fancy but forgets a key step, the end result isn't quite what was planned.
Ah, okay. That's a sneaky assumption. Good to know. All right, let's zoom in on equity valuation. We hear about the equity risk premium, or ERP. What is that?
The ERP, right? It's the extra return investors demand for choosing stocks, equity shares, over something super safe like a government bond. Stocks are riskier, more volatile, so you expect a higher potential reward for taking that gamble. It's giving risk-reward trade-off vibes.
And how do we figure out that expected return for stocks? The capital asset pricing model, or CAPM, seems popular?
Yeah, KAPM is a classic. The formula looks like this. Expected return, risk-free rate plus beta. Market return, risk-free rate. Let's break that down slightly.
Please do.
The risk-free rate is your baseline safe return. The market return is what you expect the overall stock market to return. That difference, market return minus risk-free rate, that's the market risk premium, and beta. Beta measures how much a specific stock tends to move compared to the whole market. A beta of 1 means it moves with the market. A beta of 1.5, it's 50% more volatile, swinging higher and lower.
Okay, so if the risk-free rate is 5%, beta is 1.5, and that market risk premium is 4.5%. You crunch the numbers. 5% plus 1.5, 4.5%. That gives you 11.75%. That's your required return for that specific stock using CAPM. Helps decide if it's worth the hype, maybe the jalebi baby hype.
Exactly. It gives you a benchmark based on its specific risk profile. Now, a quick technical point. When valuing equity, we generally use nominal cash flows and a nominal discount rate.
Nominal meaning not adjusted for inflation.
Right. And the main reason is that corporate taxes, which are a big deal for cash flow, are usually calculated and paid in nominal terms. So you keep everything consistent. Keep it real, but for taxes, keep it nominal.
Gotcha. Okay, let's get into the valuation models for equity shares. Picture Apibaki Haimir Dust. Our sources mention 3 big categories: dividend-based, earnings-based, and cash flow-based.
Let's start with dividend-based models. These assume the main reward for owning a stock is the dividends you receive. The simplest case, you hold the share for just 1 year. Its value today is just next year's expected dividend, plus the price you think you can sell it for, all discounted back to today.
Right, like that earlier example. Expect a euro's dividend, sell for 36 in a year, your required return is 20%, the price today should be 35. Straightforward discounting.
Exactly. Now, for holding periods longer than a year, it gets a bit more complex. You've got the zero growth model. This is if you think dividends will just stay the same forever. No glow up, just steady payouts. Value is just dividend required rate of return.
Simple, but maybe not always realistic.
Often not, no. Which leads us to the constant growth model, also known as the Gordon growth model. This one's a real workhorse. It assumes dividends grow at a steady, constant rate, G, forever. The value is D1, next year's dividend, divided by G. Key is your required return. This model is like a corporate meme that just won't die. It's everywhere.
Okay, constant growth. But what if growth isn't constant? Like a company starts super fast, then slows down.
That's where variable growth models come in. When the plot thickens, you could say. These use multiple stages. Maybe super high growth for a few years, then a transition period, and stable, slower growth forever. Think 2-stage or even 3-stage models.
Makes sense. So that covers dividends. What about earnings-based models?
Right. Some investors focus more on the company's earnings, including what it keeps and reinvests, not just what it pays out as dividends. There are models linked to Gordon and Walter that specifically look at the retention ratio, how much profit is kept, and the return the company earns on those reinvested profits.
But the really common one seems to be the price to earnings, PE ratio, or the multiplier approach. Oh, absolutely. Super common. The idea is simple. Value, earnings per share, EPS, multiplied by an appropriate PE ratio. The trick, of course, is figuring out the right PE ratio. Usually, you look at similar companies in the same industry. And just a reminder, EPS is the bottom line profit after tax, minus any dividends owed to preference shareholders, all divided by the number of equity shares.
Got it. EPS times PE. Simple concept, tricky execution, finding the right PE.
Okay.
Third category, cash flow-based models. Why do we need these if we have dividend and earnings models?
Great question. The sources point out that dividends, well, they don't always show the full picture of the cash a company actually generates. Why? Because dividends are paid after the company has already spent money on things like new equipment, capital expenditures, and managing its day-to-day cash needs, working capital. Dividend models kind of ignore that. They're a bit like Joey. Joey doesn't share food. And sometimes companies don't share all their cash flow as dividends.
Okay. So cash flow models try to capture the real cash generated. Exactly. There are 2 main types here. First, free cash flow to firm, FCFF. This looks at the total cash flow generated by the company that's available to all its investors, both debt holders and equity holders, before any debt payments are made. You discount this FCFF using the company's overall weighted average cost of capital, WACC.
Okay, FCFF is for everyone. What's the other one?
Free cash flow to equity, FCFE. This one zeroes in on the cash flow available only to the equity shareholders after all expenses, debt payments, and reinvestment needs have been taken care of. You discount FCFE using the cost of equity. Many analysts see FCFE as maybe a better measure than dividends for valuing equity because it reflects what's truly left over for the owners. It's the real MVP.
FCFE feels more direct for shareholders. Okay, shifting gears slightly, let's talk enterprise value, or EV. What's this about? It sounds big.
It is big. EV tries to capture the total economic value of a company. Think of it like a whole Bollywood family, not just one star. You calculate it starting with the market cap, the value of all the shares, then you add all the company's debt, add any minority interest, and then subtract the cash the company has on hand.
Why subtract cash?
Because if you were to theoretically buy the whole company, you'd get that cash immediately,
Sure.
effectively reducing your purchase price. EV gives a better sense of the underlying operational value, less distorted by how the company finances itself.
Interesting. And we see ratios using EV, right? Like EV to sales.
Yep. EV sales is useful for companies that don't have positive earnings or cash flow yet. Think tech startups. Sales numbers are generally seen as harder to, let's say, creatively manage than earnings, no cap. And EV to EBITDA earnings before interest, taxes, depreciation, and amortization, that's another big one.
Why EBITDA?
It's great for comparing companies in capital-intensive industries, like manufacturing, because it strips out the effects of different depreciation methods and financing choices.
Right.
Interest. It's often a go-to metric when looking at potential acquisitions.
Makes sense. Okay, one more thing on equity. Valuation of rights. What happens with a rights issue?
Right. A rights issue is when a company offers existing shareholders the chance to buy new shares, usually at a discount to the current market price. It's like giving your shares a potential glow-up opportunity. We need to figure out the share price after the rights issue happens. That's the theoretical ex-right price, or TERP.
Okay, walk me through the example. Company has 10 lakh shares trading at 13. It wants to raise 20 lakhs. It offers one new share for every 2 existing shares held, so 5 lakh new shares, at a price of just €4 each. How does the price adjust?
So you calculate the total value before 10 lakh shares. A 13 share is 130 lakhs, plus the new cash raised, 20 lakhs. That's 150 lakhs total value. And the total number of shares afterwards is 10 lakh, plus 5 lakh equals 15 lakh shares. So the TRP is 150 lakhs, 15 lakh shares equals cents per share. The price drops from 13 to euro theoretically.
And the value of a right itself.
That's simply the difference between this theoretical ex-right price and the price shareholders pay for the new share, 4. So 10 euro equals 6. That's the value embedded in each right they receive.
Got it. Okay, let's move beyond equity. What about preference shares? How are they valued?
Preference shares are kind of a hybrid. They usually pay a fixed dividend. If they're non-redeemable, meaning the company never has to pay back the principal, you value them like a perpetuity. Just the annual dividend divided by your required rate of return. Simple. If they are redeemable, meaning the company will pay back the principal at some future date, you value them more like a bond. You discount all the future fixed dividend payments and the final principal repayment back to the present.
Okay, so the example. 10,000 preference share, pays 10% dividend, so 1,000 per year, redeemable in 3 years. Your required return is 12%. You discount those €3,000 payments and the final 10,000 repayment at 12%.
And you get a present value of 9,519.63, less than the face value, because your required return, 12%, is higher than the dividend rate, 10%.
Right.
They're reliable, like that friend who always pays you back.
Makes sense. Now for the big one, debentures and bonds, the James Bond of finance.
Huh, indeed. So bonds are debt. Key features: par value, the face amount, coupon rate, the interest it pays, maturity period when it ends, and redemption value, what you get back at the end, usually par value. The valuation, it's the same principle we've been using. Present value. You calculate the present value of all the future interest payments, the coupons, plus the present value of getting the principal back in maturity.
And this leads to the bond value theorems.
Yes, some key relationships. If the market's required rate of return, called the yield to maturity, or YTM for bonds, is equal to the bond's coupon rate, the bond will trade exactly at its par value. If the YTM is higher than the coupon rate, meaning market rates have gone up, the bond's price will fall below par, it trades at a discount. And if the YTM is lower than the coupon rate, the bond's price will rise above par, it trades at a premium. Also, really important, the longer the bond's maturity, the more its price will swing up or down when interest rates change.
That makes sense. More time for the rate difference to have an impact. What about duration? Sounds like time, but it's more complex.
It is a bit more complex than just maturity. Duration is the weighted average time it takes to get back the present value of all the bond's cash flows, coupons and principal. But critically, duration is also the best measure of a bond's sensitivity to interest rate changes. Higher duration means higher interest rate risk. It's your unagi for bonds knowing what's coming with rate changes.
Ah, so duration risk measure. Okay, and immunization, how does that relate?
Immunization is a strategy to protect your bond portfolio from interest rate risk. There are two opposing risks. Price risk, rates go up, bond price goes down, and reinvestment risk. Rates go down, you reinvest coupons at lower rates. The magic happens when you match the duration of your bond portfolio to your investment holding period. If you do that, these two risks tend to offset each other, immunizing your planned return, like finding perfect corporate team equilibrium.
Clever balancing act. We also hear about the yield curve. What's that showing us?
The yield curve is just a graph. It plots the yields, YTM, of bonds, with different maturities, usually from the same issuer, like the government. Typically, it slopes upwards, meaning longer-term bonds offer higher yields than short-term ones. But sometimes it can be flat, or even inverted, short-term yields higher than long-term, which can signal different things about the economy.
And quickly, convertible debentures and warrants. These sound exciting.
They add a twist. Convertible debentures are bonds that you can, under certain conditions, convert into the company's equity shares. Warrants are similar, giving the holder the right to buy shares at a specific price, but warrants are usually detachable. You can trade the warrants separately from the original bond, and you typically pay cash to exercise them. Convertibles are usually just exchanged.
Okay, lots on nons. Let's do the quick dive into money market instruments. Short-term swag, right?
Exactly. These are for the short term, think anywhere from overnight up to a year. They're about quick funding needs or parking spare cash safely. Very liquid, generally low risk.
What kinds are there?
You got call notice money, mostly banks borrowing and lending among themselves for literally overnight or up to 14 days to manage daily cash. Treasury bills, T-bills, these are short-term IOUs from the government, sold at a discount to face value, maturing in, say, 91, 182, or 364 days. Super safe. Then commercial bills and certificates of deposit, CDs. Bills are related to trade finance. CDs are like fixed deposits you can trade, often issued by banks at a discount.
And commercial paper.
CP is basically short-term, unsecured IOUs, issued by large, creditworthy corporations to fund things like inventory or payroll. Again, issued at a discount. And we absolutely have to mention repo and reverse repo. These are crucial tools for the central bank to manage overall money supply.
How do they work, briefly?
A repo, repurchase agreement, is when the central bank lends money to commercial banks, taking government securities as collateral. A reverse repo is the opposite. Banks park their excess cash with the central bank. Adjusting the repo rates is how the central bank influences short-term interest rates across the economy. It's the market doing a quick pivot to manage liquidity.
Fascinating how it all connects. Finally, let's talk about the valuers, the people doing all this, the real heroes of finance.
You could say that. Their role has really grown. They're not just needed for investment analysis, but also for statutory valuations, things legally required during mergers, acquisitions, converting debt to equity, complex restructurings. Their job is to provide an objective, fair assessment to ensure transparency.
And they have serious responsibilities, right? A code of conduct.
Absolutely. High standards are expected. Integrity, fairness, professional competence. They must be independent, disclose any potential conflicts of interest immediately, and keep client information strictly confidential. Critically, this means no mandate snatching, trying to steal work from another valuer. And definitely no convenience valuations, just hitting a number because the client wants it. Their fee can't be based on the outcome either. No success fees. It's about objective truth, like their professional per my last email for ethical conduct.
That independence is key. What else should they consider before even taking a valuation job?
Well, good valuation isn't just about the math. It's crucial to understand the story behind the numbers, the context. Valuation involves a lot of assumptions. It's definitely not an exact science. And you can't ignore market psychology. Emotions drive markets just as much as fundamentals sometimes. So a good valuer needs to balance the technical skill with understanding the narrative, the market sentiment. Sometimes the market has a total smelly cat moment, and you need to understand the vibe, not just read the sheet music.
Love that. Okay, so that wraps up our whirlwind deep dive into security valuation. We've gone from the basic idea of investing through models for stocks, preference shares, bonds, even those quick money market instruments. The big takeaway: behind every price tag you see, there's a ton of analysis, assumptions, and hopefully a lot of professional responsibility.
So the provocative thought for you listening: next time you see a stock quote or a bond yield, what will you think? Will it just be a number? Or will you start wondering about that hidden intrinsic value? Will you think about the Kabikushi Kabigam roller coaster of its potential cash flows? Or maybe question if it's just simping to whatever the market feels that day?
The deep dive definitely continues. Stay curious, keep questioning, and remember there's often more value or lack thereof than meets the eye. Until next time, don't forget to send us your sources for our next deep dive. We're always ready to unpack whatever you throw our way.